Howdy, Jacob here. Today we're looking at Crane in the machinery industry, 3.3 billion market cap on 3.8 billion enterprise value. They operate as an industrial technology company that provides technology solutions to secure, detect, and authenticate customers' important assets. Their weird growth going on. Decline in revenue heavily over the last 5 years. I'm going to have to see if there was any sell-off of assets. I presume so, with such a big gross margin change from 34 to 44% and a big operating margin change of 11 to 21%. So I presume they might have sold off some assets that weren't really doing it for them. And if anything, it actually did help their business a bit. We see return on invested capital 11% roughly, pretty solid on less than half of revenue. So we see, good sell-off of sales, general, and admin, a good sell-off of cost of goods sold, and still pretty consistent net income. So just net income didn't really change. Revenue got hit pretty hard. But let's see if that was an acquisition or a net acquisition. Okay, so I'm not really seeing a sell-off here. Let's see the balance sheet. That would show me pretty well. Okay, they don't have 2019 data. All right, so it looks like I'm just looking at 2020 and I'm beyond. I don't really see much change here. I'd assume I would have seen a sell-off of goodwill or sell off of property and plant. And it looks like property and plant is down quite a bit from 2020. So there's a chance, and so is goodwill. So there's a chance they just got rid of a part of their business to become more efficient, which is fine. And their production of free cash flow is quite impressive. It looks like these are CapEx and then here. So it did drop quite a bit from 5 years ago. And cash from operations didn't drop nearly as much. Their use of cash is really share repurchases outside of the most recent year where there was a good reduction of debt. But right now they do have $640 million total in debt, $227 million cash. That $600 million in relation to their free cash flow is nothing. So we're not concerned about that debt figure. Just interesting based on the last 5 years, but I think I'm able to make some reasonable assumptions still. So I do think that if they sold off all their garbage, they become more efficient. I'm going to definitely lean towards these heavier, more impressive margins. And I think they'll still be able to go 3%, I think, easily. I think 15 on the P, price free cash flow, makes sense. The market average, I think their growth might be a little smaller, but I think them becoming more efficient definitely makes the investment more promising to me. And so let's lean 15 and 18, a bit of a range there. No share changes. Their dividend of $34 million is nothing, but they haven't paid one for very, very long, so I'm not going to increase it or anything. It is 1% yield, so almost in line with market average. But I'm going to leave them a little bit of money to do some other things if they want. And so this might be a little bit conservative, but I just don't have any estimation for what exactly they're going to do with their free cash flow and their capital allocation. So for now, this is what I feel fine with these assumptions, and we're saying it needs to fall in half before you get the return I'm looking for here. So interesting business. I'm just going to need it to fall a little bit more before I do more research, but I definitely would want to do more research in this company, see what they sold off a couple of years ago, see if it was, for a good reason or not. And it looks like from the numbers, it was a good reason. They increased their margins, almost doubled them, and revenue dropped in half, but earnings didn't change. So not bad from number standpoint, but from a price perspective, a little bit too much for me right now. Hope you enjoy the video and have a great rest of your day. Thanks.